Imagine a world without paper money, where moving wealth meant moving heavy, dangerous chests of coins. Long before the concept of a modern bank, the risk of transporting gold across deserts and pirate-infested seas threatened to strangle trade and empire. This is not a hypothetical scenario. It was the reality for the greatest economic powers of the medieval world, and their ingenious solution forever changed the nature of finance. The cheque, as we know it today, is a written order from a customer to their bank to pay a specific sum to a designated person or entity. We often associate its invention with Renaissance Italy or 17th century England. But the historical record reveals a far older and more global origin story. The world's first negotiable instruments, functioning precisely like cheques, emerged not in the West, but within the sophisticated financial systems of the medieval Islamic world. Our story begins not with a bank, but with a caliphate. By the 9th century, the Abbasid Caliphate, centered in Baghdad, presided over a vast economic sphere stretching from the Indus River to the Mediterranean. Trade flourished along the Silk Roads and Indian Ocean routes. This scale of commerce created a pressing problem. How could a merchant in Basra safely access funds held in Cairo? Carrying coin was impractical and perilous. The solution was a revolutionary financial document known as the sakk. In Arabic, the word simply means a written document. But in the realm of finance, it evolved a specific, powerful meaning. A sakk was a written order of payment, a promise to pay the bearer a specified amount of money on demand. It was a transfer of credit, not a movement of physical specie. The system worked with remarkable efficiency. A merchant would deposit his coin with a trusted sarraf, or money changer banker, in his home city. In return, he received a detailed sakk. This document would state the amount deposited, the name of the issuing sarraf, and often the name of the beneficiary, another merchant, or the depositor himself in a distant city. The merchant could then travel lightly, carrying only this paper. Upon reaching his destination, say Damascus, he would present the sakk to a corresponding sarraf, who was part of a wider network of trusted financial agents. After verifying the document's authenticity, a process relying on recognized signatures, seals, and complex codes to prevent forgery, the sarraf in Damascus would pay out the sum in local currency. This was not a primitive ayu. It was a negotiable instrument. Historical records, including merchant manuals and legal texts from the period, show that these sakks could be endorsed to a third party. A merchant could use his sakk to pay a supplier by writing an instruction on the back, effectively transferring the claim. This created a secure, paper-based circulatory system for credit that powered the Islamic Golden Age's economy. The robustness of this system was underpinned by two pillars: Islamic contract law and the extensive networks of the sarraf. Islamic jurisprudence, or fiqh, developed sophisticated rules for financial transactions, including those involving debt transfer and agency. Concepts like hawala, meaning transfer, provided a legal framework for these credit operations. The sarrafs themselves were often linked by family, ethnicity, or religious community, creating networks of trust that spanned continents. Their reputations were their most valuable asset, ensuring the integrity of the system. Concrete evidence of this practice is not merely anecdotal. We find it in the fragments of the Cairo Janaza, a treasure trove of medieval documents preserved in an old Cairo synagogue. These papers, belonging to a Jewish merchant community deeply integrated into the wider Islamic economic sphere, include actual saftajahs, a specific type of sakk used for long-distance transfer. One such document, dated from the 11th century, is a payment order from the city of Timis in present-day Algeria, made payable in the city of Fustat, Egypt. It is functionally indistinguishable from a modern traveler's cheque. But the narrative must resist simplification. Were these the very first? To be intellectually honest, we must look even further back for conceptual precedents. In the Roman Empire, there were systems of tabulae, or wax tablets, used to record bank transfers, but these were non-negotiable accounting entries within a single bank, not a portable, negotiable instrument. In ancient India, during the Maurya and Gupta periods, letters of credit known as adisha were used, which allowed a merchant to draw funds from an associate in another town. Similar practices are noted in ancient China with fi kun, or flying money, during the Tang dynasty's 7th, 10th centuries. These were instruments created to avoid transporting heavy copper coinage over long distances. However, a critical distinction must be made. Many of these earlier systems, while innovative, often functioned more like a telegraphic transfer or a bill of exchange between specific parties, reliant on state monopolies or specific merchant guilds. The sakk system of the medieval Islamic world appears to have achieved a higher degree of formalization, negotiability, and widespread use within a private banking network. It became a liquid instrument that could change hands multiple times, a true precursor to the modern cheque. So how did this technology travel? The pathways of finance followed the pathways of trade and conflict. As Europe began to stir from its early medieval period, its mercantile cities, like Venice, Pisa, and Genoa, found themselves on the periphery of this vast Islamic economic sphere. Italian merchants, trading actively in the ports of Alexandria, Acre, and Tunis, encountered the sakk system. They saw its utility firsthand. The Crusades, beginning in the late 11th century, brought a more violent form of contact, but also a deeper, if reluctant, economic entanglement. European knights and merchants, operating in the Levant, had to find ways to finance their campaigns. They began to use similar instruments, often facilitated by the Templars, who operated a form of international banking for crusaders. The Templars would allow a pilgrim to deposit funds in Europe and receive a coded letter of credit to be redeemed in the Holy Land. The real transmission, however, occurred through the peaceful, relentless engine of Mediterranean commerce. By the 12th and 13th centuries, Italian merchant bankers began adapting the concepts they observed. They developed the lettera di pagamento, ETH payment letter, and later the bill of exchange. These instruments bore the unmistakable imprint of the sakk. They allowed a merchant in Florence to pay for goods in Bruges without shipping silver, by using a bill that could be sold or redeemed elsewhere. The linguistic evidence is telling. The English word cheque derives from the Arabic sakk. It entered English through a circuitous route, from Arabic sakk to medieval Latin sakkus, meaning a written order, to Old French chequer, and finally to the English cheque. The term itself is a fossil in the language, marking the origin of the concept. Similarly, the Italian word for a bill of exchange, assegno, and the Spanish cheque share this etymological root. Thus, by the time the Lombard bankers of Italy and the goldsmiths of London began issuing written orders of payment in the 16th and 17th centuries, they were not inventing something new. They were iterating on a technology that had been refined and operational for centuries in the East. The Western invention of the cheque was, in reality, an adoption and adaptation. It was the final link in a chain of financial innovation that had begun in the counting houses of Baghdad and Cairo. This is not a story of isolated genius, but of cultural and economic osmosis. The cheque did not spring fully formed from a Florentine bank. It was the product of a globalized medieval economy where necessity bred innovation and ideas flowed along the Silk Roads, just as surely as spices and silks did. The modern financial world, with its complex web of credit and trust, has a deeper, more diverse lineage than is commonly taught. The paper in your wallet, or the digital transaction on your screen, carries with it the faint, enduring imprint of a medieval sakk. The stage is now set not in the bustling souks of Baghdad, but in the rising mercantile cities of Europe. By the late medieval period, the concept of the written payment order had taken root. But its journey from the Islamic sakk to the London goldsmiths' cheque was not a straight line. It was a process of fusion, adaptation, and institutionalization within a profoundly different social and legal landscape. In Italy, the bill of exchange evolved into the dominant instrument. It was more than a payment order. It was a clever tool to circumvent the church's prohibition on usury. By involving currency exchange and a time delay, it disguised interest within the exchange rate. These bills became negotiable, passing from hand to hand in a secondary market. Yet, they remained primarily instruments of merchant-to-merchant trade and international finance, not yet a common tool for individual banking. The critical transformation, which would birth the personal cheque as we recognize it, occurred in 17th century England. This is where the narrative often incorrectly begins, but the true story is one of synthesis. English goldsmiths, who safeguarded the wealth of the gentry, began issuing receipts for gold deposits. These receipts, initially simple promises to repay the depositor, started to circulate. A depositor could write an instruction on the back of his receipt, ordering the goldsmith to pay a third party. This was the direct functional equivalent of the sakk. But why did this practice crystallize here and then? History provides a concrete catalyst. The English Civil War and the seizure of the Mint. In 1640, King Charles I forcibly seized 200 thousands of private gold stored for safekeeping in the Royal Mint at the Tower of London. This act, known as the seizing of the mint, shattered trust in the state as a guardian of wealth. The wealthy turned instead to private goldsmiths, who offered security and began lending out deposits, effectively becoming bankers. The paper receipts they issued grew more formalized. By the 1660s, we find the earliest known surviving English cheques in the ledgers of a London goldsmith named Morris and Clayton. One, dated 1659, is a written order by a Nicholas Vanacker instructing the goldsmiths to pay a Mr. Delbo, Gua 400. It is complete, specific, and bears the essential elements. The word cheque itself emerged, referring to the counterfoil or the cheque, against which the main order could be verified, a practice derived from the meticulous record keeping of the serafs. Here, the intellectual honesty demands a crucial clarification. The English development was not a mere copy. It was an institutional innovation within a new context. The Islamic system operated within a framework of commercial laws, fiqh, and networks of personal trust. The English system would eventually give rise to a new legal concept: the negotiable instrument, governed by common law and statute. The landmark 1684 court case of Mills v. Oddie established the fundamental principle that a cheque was an assignment of the drawer's funds to the payee, a legal bedrock for all future banking. The timeline is now undeniable. The sakk was a mature, widespread system by the 9th and 10th centuries. The earliest known English cheque appears over 700 years later. This is not a coincidence of parallel invention. It is a case of delayed technological diffusion. The ideas migrated with traders, were observed, and were slowly adapted to fit local needs and legal structures. To claim the cheque as a purely Western invention requires ignoring this vast chronological and evidentiary gap. It is a classic case of what historians call recency bias, where later, more documented iterations in a familiar context overshadow older, foundational developments from a different civilization. But the story does not end in London. The global history of cheque, like instruments, reveals a tapestry of independent development and cross-pollination. Returning to Asia, we find compelling parallels. In India, the hundi system operated for centuries with striking sophistication. A hundi was a bill of exchange, a written order used for remitting money and financing trade. By the time of the Mughal Empire, 16th, 18th centuries, it was a fully developed negotiable instrument, with various types for different purposes. A darshani hundi was payable at sight, identical to a cheque. A mayadi hundi was payable after a set term. The hundi system was so robust and trusted that the British East India Company, upon its arrival, did not replace it. Instead, it actively used the existing hundi networks to move its own revenues and finance its operations. The colonial power adopted the indigenous financial instrument because it was more efficient than any system they could immediately impose. This is a powerful testament to the maturity of pre-colonial financial technology outside Europe. In China, the flying money of the Tang dynasty faded, but later instruments emerged. During the Qing dynasty, merchant guilds and Shaanxi banks developed sophisticated transfer systems using drafts and bills, though their negotiability was often restricted within specific guild networks. The point is not to force a single origin story, but to recognize that the problem of moving value without moving coinage was solved independently and effectively in multiple advanced economies. The Islamic sakk, however, stands out for its early formalization and direct genealogical link to the Western instrument. What are the broader implications of this corrected history? First, it challenges the persistent narrative that complex financial innovation is a uniquely Western phenomenon. The medieval Islamic world, along with other non-Western civilizations, created the foundational architecture of modern finance: credit, banking, partnerships, and of course, negotiable paper. Second, it highlights the role of civilization contact as the engine of economic history. The Renaissance and the rise of European capitalism did not happen in a vacuum. They were fueled, in part, by the adoption and adaptation of technologies, from the astrolabe to the numeral system to the sakk, that were developed elsewhere. The cheque is a prime example of this technological transfer. Finally, it restores agency and sophistication to the historical narratives of the Islamic world, India and China. Their economic history is not one of static tradition waiting for Western dynamism. It is a history of vibrant, innovative, and highly effective systems that managed vast empires and transcontinental trade. Today, the physical cheque is fading, replaced by digital transfers. But the principle it embodies, the secure, trusted transfer of a claim on value, divorced from physical specie, is the very cornerstone of our entire financial universe. From wire transfers to cryptocurrency transactions, we are still operating on that fundamental idea. So, the next time you see an old cheque or make an online payment, remember its long journey. It is a journey that began not in the coffee houses of Lombard Street, but in the treasury of an Abbasid Caliph. It was carried on camel caravans along the Silk Road, written in Arabic script on durable paper. It was honed in the offices of Cairo's saraffs and whispered between merchants in the port of Alexandria. It crossed the Mediterranean, was translated into Italian ledgers, and finally codified in English common law. The history of the cheque is a history of global connection. It is a testament to human ingenuity in solving universal problems of trust and trade. And it proves, beyond doubt, that some of our most familiar financial tools are not Western inventions. They are, in the true sense, inheritances from a connected world.